Hello, everyone, and welcome back to Global Campus Group. In this lesson, we will study break-even and cash flow forecasts. These are two very important financial planning tools used by businesses to make better decisions, prepare for the future, and reduce financial risk. A business may sell well and still face cash problems. A business may also have strong demand, but still fail to make a profit if its costs are too high. That is why managers need tools that help them understand both cash movement and profitability. In today's lecture, we will first examine cash flow forecasts, including inflows, outflows, and how forecasts are used for planning, monitoring, control, and target setting. Then we will move to break-even analysis, including costs, sales, contribution, break-even point, margin of safety, and the practical uses of break-even analysis in business decision-making. By the end of this lesson, you should be able to explain what each tool does, how it is structured, and how managers use it to improve financial decisions. Today's lecture is divided into two main sections. The first section is cash flow forecasts. The second section is break-even analysis. Within these two sections, we will also look at the most important formulas, components, benefits, limitations, and management uses. Let us begin with cash flow forecasts. A cash flow forecast is a financial plan that estimates all expected cash inflows and cash outflows over a future period. In simple terms, it helps a business predict whether it will have enough cash available to meet its payments when they fall due. This is very important because a business can be profitable on paper and still experience cash shortages in real life. Cash flow is about timing. It looks at when money actually comes in and when money actually goes out. A cash flow forecast normally shows the opening balance, the expected inflows, the expected outflows, and the closing balance at the end of each period, usually each month. Inflows, sometimes called receipts, are the amounts of money coming into the business. The main inflows in this lesson are cash sales, credit sales, loans, capital introduced, sale of assets, and bank interest received. Cash sales are money received immediately from customers. Credit sales are money received later from customers who bought on credit. Loans are borrowed funds from banks or other lenders. Capital introduced is money invested by the owner or owners into the business. Sale of assets is cash received from selling equipment, property, or other business assets. Bank interest received is money earned from savings or bank balances. The important point is that these are all examples of money entering the business and improving liquidity in that period. Outflows, sometimes called payments, are the amounts of money leaving the business. The main outflows in this lesson are cash purchases, credit purchases, rent, rates, salaries, wages, utilities, purchase of assets, value-added tax, and bank interest paid. Cash purchases are goods or materials paid for immediately. Credit purchases are payments made later for goods or materials bought on credit. Rent is payment for business premises or land. Rates are payments to local authorities on business property. Salaries are payments to permanent staff. Wages are payments to temporary or hourly workers. Utilities are expenses such as electricity, water, and gas. Purchase of assets is money used to buy equipment or property. Value-added tax is an outflow paid to the government by VAT-registered businesses. Bank interest paid is the cost of borrowing money. The key idea is simple. Outflows reduce the cash available to the business during the period. Cash flow forecasts are used in four very important ways. First, they are used for planning. They help the business prepare for future months and identify periods where there may be a cash surplus or a cash shortage. Second, they are used for monitoring. Managers can compare actual cash flow against the forecast and check whether inflows and outflows are happening as expected. Third, they are used for control. If a cash flow problem is predicted, managers can take corrective action, such as delaying spending, negotiating with suppliers, or arranging finance in advance. Fourth, they are used for target setting. They help businesses set financial goals and benchmarks for sales, receipts, and spending. So, a cash flow forecast is not just a table of numbers, it is a planning and control tool for management. Like all financial tools, cash flow forecasts have both strengths and weaknesses. The benefits are that they improve financial planning, identify possible cash shortages in advance, support better decision making, and can also be used as part of a business plan when seeking finance. However, there are also limitations. A cash flow forecast is based on estimates, so it may be inaccurate. It cannot fully predict unexpected events, such as a major customer paying late or an unexpected increase in costs. And if assumptions change, the forecast can quickly become out of date. So the forecast is useful, but it must be reviewed regularly and not treated as guaranteed fact. We now move to the second major tool, break-even analysis. A break-even analysis identifies the point at which a business's total costs and total revenue are equal. At that point, the business makes no profit and no loss. This is very important because it tells managers the minimum level of output or sales needed to cover all costs. Below the break-even point, the business is making a loss. Above the break-even point, the business is making a profit. So, break-even analysis helps answer a very practical question. How much must we sell before we start making profit? To understand break-even analysis properly, we must first understand costs. Variable costs change directly with the level of output. Examples include raw materials or packaging. Semi-variable costs contain both fixed and variable elements. A common example is a telephone bill with a fixed charge plus extra usage costs. Fixed costs stay the same regardless of output, at least within the relevant range. Examples include rent or insurance. Total costs are the sum of fixed and variable costs. These cost categories are essential because break-even analysis depends on how costs behave as output changes. Now let us look at the sales side of break-even analysis. Total revenue is the total amount of money received from sales. Total sales may refer to the number of units sold or the total value of sales. Selling price per unit is the amount charged for 1 unit of product. And sales in value and/or units show either how much revenue is generated or how many units are sold during a period. These measures matter because break-even is based on the relationship between sales revenue and costs. Now we come to the most important calculations in this topic. Contribution per unit is calculated by subtracting variable cost per unit from selling price per unit. So, contribution per unit equals selling price per unit minus variable cost per unit. This tells us how much each unit contributes towards covering fixed costs, and then, after break-even, towards profit. The break-even point is then calculated as break-even point equals fixed costs divided by contribution per unit. This gives the number of units that must be sold to cover all costs. The margin of safety is actual sales minus break-even level of output. This shows how much sales can fall before the business starts making a loss. Total contribution is calculated by subtracting total variable costs from total sales revenue. Contribution is useful because it helps a business understand how sales are covering fixed costs and contributing to profit. The benefits of contribution per unit are that it helps businesses assess product profitability and make pricing decisions, but it also has limitations. It ignores fixed costs when considered on its own, and it assumes that all units produced are sold. So contribution is a valuable tool, but it should be used alongside wider business judgment. Break-even analysis can also be used in 4 important management ways. For planning, it helps identify the level of output needed to cover costs and supports pricing and budgeting decisions. For monitoring, it allows managers to compare actual sales with break-even sales and judge how close the business is to profitability. For control, it highlights changes in costs or selling price that may affect profit, allowing managers to respond. And for target setting, it helps establish clear sales and output goals for the business. So break-even analysis is not only a calculation, it is also a strategic planning tool. Let us now summarize the lesson. A cash flow forecast helps a business predict cash inflows and outflows and manage future liquidity. It is especially useful for identifying periods where cash shortages may occur. A break-even analysis helps a business identify the point where total revenue equals total costs. It shows the sales level required before profit begins. To use break-even effectively, businesses must understand fixed costs, variable costs, semi-variable costs, total revenue, contribution per unit, total contribution, and margin of safety. And both tools are valuable because they support planning, monitoring, control, and target setting. Thank you for watching this lecture on break-even and cash flow forecasts. I will see you in the next lecture.